Welcome back to another episode of Rogue Agent Answers, and this week's question, we'll get right into it. What is the rate of return on my policy? It's a good one. So rate of return on cash values and death benefits in whole life insurance, universal life insurance, especially in whole life insurance, it's tricky to calculate unless you have access to and know how to use Excel spreadsheets. This is particularly with whole life insurance, and then even then you have to be able to run the IRR function in a very particular way. You could also get or ask for a printout from the insurance company. They can print those reports for you. On their end, their software is set up to do that. It's fairly simple. It's a report that they can print off for you, or your agent can print it for you. But people tend to want an answer like, well, is it making 5% annually or 3% or whatever? And I tend to give a range of returns between, I might say somewhere between 3 and 5% annually. But there's a qualifier with that, as long as the dividend rate doesn't change on a particular policy. So the trouble with trying to tease out what the quote unquote rate of return on a life insurance policy is because all cash value life insurance policies essentially work the same way. Premiums get paid in. The insurance company deducts expenses for mortality and operating expenses, and then whatever's left over is credited back with interest credits. In a UL policy, it's credited back with whatever the portfolio rate is that the company's paying. Rarely in new money rates, but usually a portfolio rate of what the insurance carrier's general investment account's doing. And with whole life, it's the general investment account portfolio rate plus dividends, whatever they're going to declare for the year for dividends. So because of that, every year it's in the piece, the thing that sort of alters the annual rate of return is the expense piece. So premiums in, expenses out. So each year the expenses are changing a little bit. Why? Well, you're getting older. And so every year that you get older, the mortality charges are changing just a little bit. Your risk of death is different, right? Usually over time, the risk of death increases as you age. So the cost to provide the insurance is going up. Now, the amount of insurance that you're buying tends to go down. With whole life, it's guaranteed, your what's called your net amount at risk is going down. So the insurance charges are coming down, but the cost per thousand is rising. So every year, it doesn't matter, your charges are changing. So even if you knew the rate of return in advance, your actual return is changing depending on how your policy is structured, what the net amount at risk is, if the agent designed it to maximize cash value and so on, or to push up the death benefit. All that affects what your rate of return is, because all that affects the mortality, the internal charges of the policy. So the reality is there can be a lot of variability over time, and even from policyholder to policyholder, even if you're looking at the same exact product, depending on how it's designed. It depends on the risk rating, the age, and when the policy was taken out, how much premium is going in, and so on. So the reason life insurance has such a variable return, again, is the way that life insurance policies are structured and the mortality charges that are being taken out. Each year, that insurance company is assessing those charges against the earnings it generates on your premium dollar, and that's what's changing this. So the per $1,000 of mortality charges is, as I said, is increasing every year by a known guaranteed amount, but it's still changing. So it's not like a constant, even if the crediting rate, even if the dividend interest rate on a whole life, for example, even if that stayed at, let's say 6%, the cost per thousand has changed. So this, along with a few other factors, is going to cause the rate of return to fluctuate over time. So insurers might also shape the rate of return inside the policy to influence how those cash values grow over time. So for an example, an insurance company might refund a bunch of operating expenses after several years just to juice the internal rate of return on the policy, and return it through the dividend. And it would be the expense savings, part part of the dividend. So this is why policyholders will often see rates of return that steadily climb for decades, then fall, and then maybe rise again or level out, and then the return pops up again at the extreme older ages when the policy endows. So insurance, the illustrations tend to show level or flat dividend rates just on the illustration, but in reality, as the dividend rises or falls, this has a dramatic effect on the rate of return in the policy, along with, again, those expense charges. All right, that's it for this week's question, and I will see you in the next one.